The S&P 500 is doing something that it's never done before. Is this a good sign or a bad sign? I've got two reasons to be cautious. I'll explain that and more coming up. There's growing speculation that we are in an AI-driven stock market bubble. And of course, prices have soared again, not only in the S&P 500 this year, but last year as well. And stocks and names like NVIDIA and these big tech companies are leading the charge. There's no question about that. Typically, though, a bubble means that prices are completely detached from profits. That's what we saw during the last big bubble, the tech bubble, where you had, anywhere a company was saying anything about the internet, whether they had profits or not, their stocks were soaring. I will say that is a little bit similar right now. Anytime a company is saying anything about AI, there's a lot of optimism and hope. But does that mean we're in a bubble? Well, more people are getting concerned. And well, listen, stocks climb a wall of worry. That's one popular investing saying. Another is that at all times, the stock market is seeking to prove as many people wrong as possible. Okay, so there's a lot of sayings there to keep you invested. Another common investment saying is concentration builds wealth, diversification helps preserve it. Well, if you've been holding the S&P 500 index, maybe an index fund, exchange traded fund, thinking that, well, I've got this diversified holding of 500 large company stocks, you've never been more concentrated in history. That's right. Take a look at this chart. This is showing the concentration of the top 10 holdings of the S&P 500 as a weighting of the entire index. You can see that we've blown past previous records, now over 40% concentrated. So the S&P 500 is a cap-weighted index, a market cap-weighted index, meaning of the 500 companies, it's not that each company gets a 1/500th share or representation, right? It's the larger the company, the larger the percentage. And so this is saying, we all know, we've heard plenty about the Magnificent Seven. This is the top 10 holdings now equal over 40% of the entire index. Never in history has this diversified holding of 500 companies been so concentrated, been so top heavy. Is that a risk? I think so. However, speaking about bubbles are when prices get detached from profits. Take a look here at this report here from JP Chase. Now, this is Magnificent Seven, but you can see here the earnings of the Magnificent Seven have actually been very, very strong. And there's a lot of optimism about where those earnings are going. And the top right here in the green, that is the earnings growth of the Mag 7 compared to the earnings growth of the S&P 500 minus the Mag 7. So basically the S&P 493. You can see it's not even close. You can see that the Mag 7 is actually driving the earnings growth compared to the other 493 stocks. So earnings growth and profits from the Mag 7, and obviously by representation then a lot of the top 10 holdings in the S&P 500 that are so concentrated, earnings growth, they're the ones leading the charge. So how do you interpret it? Is this good news or bad news? I'd make sure that you're tuning into your financial plan, that you're taking the right investment strategies that align with the right risk level for your situation, for your time horizon, for your unique financial plan. But there are two reasons. If you look at that and say, yeah, no, there's good reason why the stock market's seeing all-time highs. We are at the very, very beginning, first floor of the AI revolution. Things are just taking off, and those companies, they do have strong earnings. You might look at this and say, yep, everything's just fine. But there are a couple of reasons to be cautious. First, I've heard more and more people say that these 10 companies, or even the Mag 7, these are the companies that you would invest in for the rest of your life. And that may be true. However, if you look at the top 10 holdings right now of the S&P 500, and yes, more concentrated than ever, compare that to what the top 10 were 10 years ago. And 10 years before that. In 2015, yeah, you had Apple and Microsoft, so you had a couple in Berkshire Hathaway. You had a few that are in the top 10 today. JP Chase was in there as well. But you had a few other names. GE, even 10 years ago, GE was in the top 10. ExxonMobil, J&J. Yeah, there were some names that are still household names, but you wouldn't look at them as leaders, as economic leaders or stock market leaders. 10 years before that, 2005. And you might say that was a different world. I know, but the point here is that what we're looking at today, and I know how you're looking at it, how I'm looking at it is, yeah, Apple, Nvidia, I mean, these are the companies that are they're paving the way for the future. So nothing's going to knock them off their game. They're going to be a top 10 holding. They're going to be driving and leading the S&P 500. Certainly they're so concentrated. They're going to be leading the economy out there in the future. And yet this chart shows things change. The top 10 changes. It's unlikely that in 2035, these same top 10 names that are driving the stock market today, this 40% concentration in these names, are going to be the same 10 names out there in the future. In fact, history would suggest it's unlikely to be even 7 or 6 or 5 of these names will persist 10 years from now and 20 years from now. So that's a reason to be cautious. The more concentrated things are, the more disruptive it can be when other leaders emerge and these current leaders begin lagging. And then a second reason to be cautious. I mentioned that bubbles are formed when prices get detached from profits. This here is a chart that I use all the time. I look at it every single month when JP Morgan updates it. Technically, they update this on a daily basis, but once a month, and this is the end of October, so what it's reporting right now. This is the price of the S&P 500 compared to the forward projections of earnings, the expected projection of earnings. Now, the good news is that this earnings season, just like many others, typically, on average, companies outperform what they project earnings to be. I think this was, 2/3 of companies, again, outperformed their earnings that they projected. So price compared to those projected earnings, what you can see here, this is a very high price to earnings, meaning the stock market has appreciated significantly over the past year, over the past 2-3 years, really stemming from the bottom in 2022. But earnings have grown, but haven't grown as much as prices. So whether you want to call it a bubble, I think we'll only know in hindsight, but certainly this chart shows that prices are now stretched. They are inflated compared to the underlying economic activity and the earnings of these companies, surpassing now the highs that we saw before the stock market decline in 2022, and second only to the internet, the tech bubble that we saw in the late 90s, early 2000s. What do you do with this information? If you're a long-term investor, this is not a time where you grab the wheel and overcorrect. No, you tune to your plan. You make sure that you've got the right investment strategies. We like using multiple strategies because the primary strategy of just diversifying, don't have all eggs in the same basket. Well, a lot of the baskets look and feel the exact same these days. They might be invested in mid cap as opposed to large cap, but if the market goes risk off, all of those tend to move in the same direction at the same time. So I would consider using multiple strategies as well, but then also tuning into your financial plan so that you're taking the right level of risk for your financial situation. If you still have a long time horizon, even if this suggests, the market could get a little dicey here, make sure you've got your seatbelt on and make sure that you're aware that there could be some volatility. Doesn't mean that you need to adjust your risk tolerance. Work with your certified financial planner, take the right strategies, make sure it's connected to your financial plan, and then make sure you are invested appropriately for whatever lies ahead. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneystore.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.